Hi, this is Kirubakaran Rajendran. Welcome to Trading with Groww channel. In this video, we're going to talk about options buying, specifically focusing on expiry days. So what are the things that you need to keep in mind when you are dealing with option buying, and specifically with respect to Bank Nifty expiry and Nifty expiry when you're trading on Wednesdays and Thursdays, important parameters that you need to consider, and how you could trade successfully with respect to options buying on expiry days. When it comes to expiry days, we have expiries from Monday to Friday. You know that now on Monday we have mid-cap expiry as well as bank expiry, and Tuesday we have fin nifty expiry, and Wednesday we have bank nifty, and Thursday we have nifty expiry, and Friday we have sensex expiry, right? So definitely it is not that you are going to focus only on nifty and bank nifty. You can trade on other days, but comparatively the liquidity is very minimal in other instruments compared to nifty and bank nifty. That is why in this example we are going to consider only nifty and bank nifty for the complete video. So to get started with, why do you need to focus on option buying with a different mindset than option selling is? See, with respect to option selling, lot many people go for that because of higher winning accuracy. So definitely lot many OTM options is going to expire on expiry days, worthless on expiry days. So obviously many people bet that okay, 500 rupees away, 1000 rupees away, OTM options are going to expire worthless, so they do this option selling. But with respect to option selling, as you know, the risk is much higher when suddenly market moves in one-sided direction, and also the margin requirement is comparatively higher. But with respect to option buying, the overall requirement for margin is very minimal, right? And also with respect to option buying, the risk is limited. Whatever the premiums that you pay, that is a risk, that is no what you are going to pay as a overall risk. So you know all these things as a normal option buyer, but what are the things that you do not know, or what are the things that you're not familiar with? That is what we are going to address now. See, with respect to option buying, the first thing you need to consider is whatever your strategy is going to be. With respect to option buying, the first thing that you need to remember is 80% of your overall profits will come from less than 20% of your trades. So what does that mean? Which means that if you're taking 100 trades, out of this 100 trades, if you see the backtest results, you might give you, okay, overall you are making 80,000 profits or 1 lakh profits, but that 1 lakh or 80,000 overall profits will be coming from 20% of the trades. So if you're taking 100 trades, 20 trades is going to give you enormous profits. Rest 80 trades is going to give you a minimal loss, or sometimes a max loss. Sometimes there will be no profit, no loss. So your overall option buying result is determined by 20% of the trades. So that is why it is psychologically very, very difficult to trade option buying compared to option selling, because you have to see multiple losses back to back. So if you are seeing 4 losses, 5 losses back to back, still you have to take that 6th trade, but you can't skip that, because you never know when that bigger trades is going to come, when that bigger trend is going to come. So that is why it is extremely important to focus on each and every trade and trade it without skipping it. Only then you will be able to achieve that end results of making bigger profits. So with respect to option buying, the first thing is 80% of your overall profits will come from 20% of the trades. And the next thing is, when you're dealing with option buying on expiry days and non-expiry days, the first thing that we need to focus on is decay. All the options are going to decay much faster on expiry days, right? So as an option buyer, we are already at a disadvantage, because no matter what kind of trades that you're going to place, definitely that option is going to decay. So when you are dealing with option buying on expiry days, two things we need to focus on. One is what type of trading strategy you are going to deploy, whether it is going to be a directional system or non-directional system. So when you deal with this directional or non-directional, what it means is you cannot simply buy a long straddle or long strangle, which means we cannot simply buy both the ATM options, call options and put option, and expect the market to give you profits. So I'll explain you what happens if you go non-directional trades, do non-directional trades on expiry days with a backtest result, so that you will understand. Because lot many people simply buy a call option and put option together on expiry days, thinking that one side market will move and they can make profits. But if you do that, on the long run, that is going to give you loss. Let me explain that with the result. So I'm going to explain a third-party tool using which I'm going to explain how the backtesting works, and how if you do a buying a short straddle, instead of doing a short straddle, if you are just buying a long straddle, like buying at the money option and buying at the money put option and call option, what would be the overall result if you do this? So I just go to this algo test platform, and I've just selected buying a put option at the money and buying a call option at the money, and I wanted to keep a stop loss. Say suppose I wanted to keep a stop loss of, no, since we are buying, we can give 50%, or we can just give some 30% of stop loss. Okay, so we are buying at the money call option and at the money put option at 9:30 with respect to ATM options, and then I'm trying to back test it. So if I just run this back test on Bank Nifty, it is going to give me what would be the overall results if I simply go non-directional, buy both call option and put option. Now let's see what would be the overall backtest results. So if you see the overall backtest results, it will give you all days, like Monday to Friday, the overall results will be shown. But for us, what we have to check is, we just need to check only on expiry days. So if you see, it is overall a loss making strategy if you simply buy both call option and put option. But let us focus on expiry days. So what would be the overall result if I focus only on expiry days? So this is the overall results if I only focus on expiry days. Still, that is also overall did not make good profits. So overall it still ends up in a loss. So if you consider maximum drawdown is almost what, 55,000. So overall profit is just 4,000. If you include transaction charges and everything, it is going to end up in loss only. So if you simply go non-directional as a strategy with respect to option buying on expiry days, that is not going to give you profits. So the right way to focus on expiry days is to go directional. So how do you trade directional on expiry days? I'll explain with another example. So in order to go directional, what we have to do is we have to wait for the market to move up or move down. If it moves up, we will buy call option. If it moves down, we will buy put option. This is the idea, right? So what I'm trying to do is, I'm just going to modify the rules here. So I'm buying no put option and buying call option here. And now what happens is, I'm going to select range breakout and I'm going to select underlying. It will wait between 9:30 to 9:45 and it will check what is the overall trend. So let's do one thing. So we can change the overall range from 9:16 to 9:45. So we will wait for the first half an hour for the markets to establish a range. When that range is broken, we are going to get into a trade. So what happens is, I have selected a range where from 9:15 to 9:45 for the first half an hour it will wait and track the underlying, and when the underlying low is broken, then we will buy the put option. Similarly, with respect to call option, if the underlying high, range high, so it will wait for the first 30 minutes. If the first 30 minutes high is broken, we will buy call option. If first 30 minutes low is broken, we will buy put option of the underlying, which means whether it is Bank Nifty or it is Nifty, whatever the spot. And then we'll use the same 30% stop loss. Now we will run the back test and see how the overall result is. Earlier we went non-directional and the result was negative. So now we are going to change that from directional and see how the overall result is going to be, whether it is going to be a profitable one or it is going to be a loss one. So similarly, just like the last one, this will also give you the result for all days. So we have to focus on expiry days alone. So if you see on all days, the overall profit, actually it is given overall a profit of 2,92,000. So if you are buying call option or put option on a directional basis, and overall drawdown is around 85,000. Now I wanted to focus on 0 DTE, which is on expiry days alone. So I have selected 0. Now it has given me the overall results. So if you see, overall result is approximately 80,000 profits with around 20,000 of maximum drawdown. With the winning accuracy, if you see, it is only 27%. As I said earlier, your maximum profits will come from few trades, but the idea to showcase this is directional versus non-directional. You have to go for a directional trade when you're trading on expiry days. And the next thing we have to focus on is strike selection. See, in the earlier example which we have shown, the directional is working well compared to non-directional. We have used at the money options, and at the money options is giving us this much profit with just 27% winning accuracy, right? But with respect to expiry days, at the money and OTM will have a higher decay. So what we are trying to change now is, instead of at the money option, if we trade in the money option, so I'm just changing to in the money. So 2 points in the money options, 2 legs in the money options. If I do it and then run the back test, it will tell me how the overall result is going to be, whether it is much better than ATM or it is better to stick to ATM. So when you have this comparison between ATM options and then in the money options, specifically on expiry days, the decay factor will be much lesser, because with respect to options on expiry days, the decay is much faster than other days. So with respect to in the money, if you see, the overall results is much higher. Earlier we saw around 2.9 lakhs profits. With respect to in the money, it is almost 3.8 lakhs profits on all days. Now if we shift to expiry days, it will show you what is the overall profits if you trade in the money options. So with respect to in the money, if the overall returns is doubled. So earlier we saw 80,000, now it is almost 1.5 lakhs of overall profits. And the next thing is the maximum drawdown is also relatively smaller, which is 30,000. And if you see the winning accuracy from 27% with respect to ATM options, now it is increased to 45% with respect to in the money. So which clearly shows that when you are dealing with option buying on expiry days, you should not only trade directional, you should also trade with respect to in the money strike instead of out of the money or ATM. And one more thing that you need to keep in mind is, instead of all these things, many people lose money with respect to option buying is following the wrong position sizing. So when you're dealing with incorrect position sizing, incorrect number of lots, definitely no matter what, it is going to end up in loss in the long run. So what is the ideal way to trade with respect to option buying with the right position sizing? What it means is, if you have 1 lakh of capital, do not put all your 1 lakh of your capital in just one trade and expect to make 10x or 20x returns, because options buying, you can't predict the outcome of the result much before. There is a higher possibility that that is going to end up in loss. So when you are putting all your capital in just one trade to make it big, it is not going to work, because as I clearly shown, the overall winning accuracy of any option buying system will vary from 25% to 45% max. That is all you're going to win, which means that if you're taking 10 trades, definitely 6 trades minimum will be in profits, and maximum even 7 or 8 trades can also end up in loss. So which means that when you're risking all your capital in one trade, that can totally wipe you out. So the ideal way to trade option buying is to risk X percentage of your overall capital in each trade, which means that, say suppose I have 1 lakh of my overall account, what I'll do is I wanted to take only 10% of my overall capital as risk, which is 10% of 1 lakh is 10,000. So now I know I wanted to put only 10,000 worth of risk in this option buying trade. So how many number of lots should I buy? This is the question you need to ask. So when I'm buying an option, it is going to tell me, okay, this is the overall option premium, and for one lot, this is the overall margin requirement. And when I keep a stop loss of X percentage, this is the overall risk. Now I need to decide how many number of lots I should buy. So I'll explain with an example so that you can apply the same logic when you're trying to deal with option buying next time. So let us consider this position sizing example. This is the most important one you need to follow when you are dealing with option buying on expiry days. So consider my capital is 1 lakh. Okay. And in that 1 lakh, we are going to trade an option buying with position sizing and without position sizing. If you do this, what would be the overall different results that you might get? Say suppose now we are dealing with the bank nifty, okay, and bank nifty we are buying a put option for an example. So 45,000 P is the one which we are going to trade as per the strategy which I have explained, and entry price is, say suppose 400 rupees, and stop losses we are using 30% on the entry premium, which is 30% of 400 is around 120. So 120 is the overall premium risk we are going to take. So that 120, if you consider with one lot, then my overall risk is 1,800 rupees for one lot. And with respect to margin, so if I have to buy just one lot here, 6,000 rupees is the margin, because 400 rupees is the premium, 15 is the lot size for bank nifty, so 6,000 rupees is the overall margin requirement, right? Now what I wanted to do is, I don't wanted to put all my 1 lakh in this trade. Instead what I'm going to do is, I want to risk 10 to 12% of my capital in every trade. So out of 1 lakh, 12% is what? 12,000 rupees, right? So now I will decide how many number of lots I can buy so that my maximum loss should not exceed this 12,000 rupees. So based on the stop loss risk, which is 1,800 rupees risk for one lot, I can calculate how many number of lots I can buy now. So what you can do is, see, this is the overall risk, which is 1,800, right? So you just divide this 12,000 rupees by 1,800, which is going to give you approximately 6.6 lakh lots, which is, if you round it off, it will be around 7 lots. That's all. Okay. So now I can buy only 7 lots. But with full capital, if I wanted to buy it, I can buy almost what 17 lots, which is nothing but 1 lakh divided by the margin requirement for one lot, which is 6,000 rupees. So I can easily buy 16 no lots or 17 lots. So consider 16 lots. So now what happens if I trade with position sizing and without position sizing? What would be the overall results? So if I trade with the full capital, which is if I completely trade with all my 1 lakh where I can buy 16 lots, then if the stop loss is hit, I am going to lose 28.8% of my overall capital, which is almost 30% of my capital is gone if the stop loss is hit. Now, if the stop loss is hit with respect to position sizing, where when I buy only 7 lots, then as you could clearly see, the maximum number of the loss that I'm going to face is only 12.6%. So based on the number of risk percentage that you are going to keep with respect to your capital, the number of lots will vary, and accordingly your risk factor will go down tremendously. So this is how you need to risk with respect to option buying. You can totally reduce it to how many number of percentage that you wish. If your capital is higher, say suppose if my capital is instead of 1 lakh, if it is 10 lakh, I don't want to risk 12% in each trade. Instead I can just risk maybe 5% in each trade, so which is just 50,000 rupees. So if I just risk 50,000 rupees, what will be the number of lots that I can buy? So as you can clearly see, 27 lots I can buy, and with full capital, how much I can buy is almost 166 lots. So huge difference. When I'm putting all my capital in just one trade, number of lots I can buy is huge. Similarly, the number of percentage of loss that I can lose is also significantly higher. So always decide how much percentage you want to risk on your capital, and then accordingly calculate what is the ideal number of lots that you can trade. So these are the things that I want to convey with respect to in this video. So keep these things in mind, specifically when you're trading with option buying. Your overall returns to risk reward ratio is comparatively much higher, but the overall winning accuracy will be much lower. And second thing is your overall profits, 80% of your overall profits will come from less than 20% of the trades. So that is why it is very important to risk very minimal percentage with respect to each and every trade. And the second thing is always focus on directional versus non-directional. When you're trading with a non-directional in option buying, it might not give you the clear results as I explained in the video. You have to go with directional only. And the last thing is choose the strike wisely. At the money options and OTM options can decay much faster on expiry day, so you end up losing much higher if you trade with these two strikes. Instead, go and trade with the in the money strike so that your winning percentage will also be higher, overall returns potential will also be higher. So this is what I wanted to convey in this video. I hope you found this video really helpful. I'll see you guys next week with another video. Bye.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.